Good morning. I want to talk about yield farming this morning. This is a new craze in cryptocurrency and decentralized finance. It began when compound finance was released into the market. I remember I was in a chat group and I remember the day that compound came out and we were analysing it technically, but we didn't have any data to look at it. Yield farming is a way that you can make your crypto earn you money. So it involves lending your crypto funds to others through the magic of computer programs, and they're called smart contracts. I've been learning about smart contracts at Block Geeks for a long time now. It's an ERC20 token based on the Ethereum platform. It's where all the ICOs began. It sounds simple, right? Lending your crypto, lending your funds to others to earn you money. Well, actually, it's very complicated. Complicated strategies. There's cryptos being moved around all the time between different lending marketplaces. And it's also very secretive, yield farming. Why is it secretive? Because the people, they know a strategy. And the less effective, the more that know about the strategy, the less effective it will become. It's really the Wild West of decentralized finance. It's also for whales more. You know, it's not for your sole trader. You know, someone trading a little bit, buying a bit of Bitcoin here and there, maybe a few other altcoins. It's not for that. It's the Wild West of DeFi. It's been at the forefront, DeFi, hasn't it, of the blockchain revolution, innovation this year. DeFi's been the buzzword all year. I do beg your pardon. It's a trustless system, which is trustless means that you don't need to have two people agree on something, so it's trustless. It's a incentivized way of doing things where you don't need two people to agree on the transaction. That's what trustless means. It's a way of earning passive income, similar to staking. So how would a yield farmer, it's a farmer, how would they tend to their crops? You know, as in, like, mining is like the old-fashioned mining where you go down a mine with a pickaxe and you start trying to mine metal or whatever you're doing down there in the mine. Farming, yield farming, how do you tend to your crops? And what kind of yields can you expect? You know, it can be called liquidity mining as well. It's another common phrase for it, and how it originated was yield farming. It can be sort of looked at and paralleled with staking. So in many cases, liquidity providers add funds to liquidity pools. A liquidity pool is a smart contract that contains funds. That's all that is. So when someone asks you what a liquidity pool, it's a smart contract, but it contains funds. So it's a live smart contract. Some liquidity pools pay their rewards in multiple tokens. This is where the Wild West bit comes in. You know, there's complex strategies, and it's a basic idea, but it can be very complex. And yield farming is done, as I say, with the ERC20 tokens. Yield farmers typically they move all their funds into different protocols in the search of higher yields at the time. So as a result, DeFi platforms may provide incentives so you use their platform. It's like a centralized exchange, like the ICOs. They'll incentivize you to use their platform over others, like they're in competition. So it started, a strong interest in yield farming started with the comp token, the compound finance ecosystem. and it's a governance token granting governance rights to token holders. A common way to kickstart a decentralized blockchain is distributing these governance tokens algorithmically with liquidity incentives. It's a lot of long words for you there. All it is this is attracting liquidity providers to farm the new token, providing liquidity to the protocol. While Comp didn't invent yield farming, this is the distribution model that it's based on. So if you remember when Comp came, that's when this yield farming thing popped up. Okay, there's a TVL mentioned quite a lot with yield farming. That's the total value locked into the yield farming scene. So it measures how much crypto is locked in DeFi lending and other types of money in other marketplaces. It's the aggregate liquidity. The aggregate being, you sometimes have these apps that aggregate the scores of the price of crypto across multiple exchanges, because there can be some variances. So you'll get an aggregate, which is like the average across the exchanges. It's all them added up and then divided by how many there are. So it's like an average, it's an aggregate. There's a platform called DeFi Pulse to track TVLs, total value locked. And the more value that's locked, the more yield farming is going on. You can measure the total value locked in ETH, USD. You can even do it in BTC. The DeFi stable coins, USDC, USDT, and each will give you a different outlook for the state of the DeFi money markets. It works on a model called Automated Market Maker, AMM, and it typically involves liquidity providers and liquidity pools. The pool powers a marketplace where users can lend, borrow or exchange tokens. The usage of these platforms incurs fees, which are then paid out to liquidity providers according to their share of the liquidity pool. This is the foundation of how an AMM works. The implementations can be vastly different though, so not to mention that this is a new technology. It's beyond doubt that it's going to change a lot going forward. At the moment, I think it's a risk. It's a big risk, and it's for whales mainly. Bear that in mind. On top of fees, another incentive to add funds to a liquidity pool could be the distribution of new tokens. For example, there may not be a way to buy a token on the open market, only in small amounts. And then on the other hand, it may be accumulated by providing liquidity to a specific pool. You see, it's a complex issue. It's a simple idea, but with these new tokens popping up here, there and everywhere, the rules and the boundaries being changed all of the time, it's a complex issue following it. So getting involved with it is high risk. It's not all guaranteed money that you can make. You can easily lose money. Remember what happened to mining, and in 2017 there were various schemes and things that came out of that where money was lost. I've just forgotten the name of one, mining rigs. I've forgotten the name. There was a group that I was in that were into it. There was a lot of money lost in early 2018. So the funds are usually deposited in these liquidity pools in stable coins, in DAI, in USDT, USDC and BUSD, Binance Coin USD. Some protocols will mint the tokens. For example, if you deposit DAI into Compound, you'll get CDAI, or Compound DAI. If you deposit ETH into Compound, you'll get CETH. And as you can imagine, there can be loads of layers of complexity to this. So you could deposit your CDAI into another protocol that mints a third token to represent your CDAI that represents your DAI, and so on and so on. These chains can become really complex and really hard to follow, I warn you. The returns are calculated annualized really. So they estimate the returns are over the course of a year. Some commonly used metrics are annual percentage rate and annual percentage yield, APR and APY. The difference between them is that APR doesn't take into account the effect of compounding, while APY does. Compounding in this case means directly reinvesting profits to generate more returns. However, be aware that APR and API may be used interchangeably, which complicates it more. It's also worth keeping in mind that these are only estimations and projections on the annualized. Even short-term rewards are difficult to estimate accurately. Why? Why is that? Because yield farming is a highly competitive, fast-paced market. The technology is changing all the time and the rewards can fluctuate rapidly. For example, if a yield farming strategy works for a while, many farmers will jump on this opportunity and then it will stop returning high yields, high return yields. As APR and APY come from the legacy markets, DeFi may need to find its own metrics for calculating returns. And due to the fast pace of DeFi, weekly or even daily estimated returns may make more sense, but at the moment they're not listed. So what is collateralisation in DeFi? Typically, if you're borrowing assets, you need to put up collateral to cover your loan. You need to put something up as collateral. This essentially acts as an insurance for your loan. How is this relevant? This depends on what protocol you're supplying your funds to, but you may need to keep a close eye on your ratio of collateralization. If your collateral value falls below the threshold required by the protocol, your collateral may be liquidated on the open market as a margin, like a margin account. If you go below your maintenance margin level, your account will be liquidated and you lose everything. What can you do to avoid being liquidated? Well, you add more collateral, the same as you would in a margin account when you're trading leverage. Each platform will have its own set of rules, i.e. their own required collateralization ratio. In addition, they commonly will work with a concept called over-collateralization. This means that borrowers have to deposit more value than what they want to borrow. Why is that? To reduce the risk of violent market crashes liquidating a large amount of collateral. So, you might have to put in a bit more than you first thought or you first was advertised. So, for example, let's say the lending protocol you're using requires a collateralization ratio of 200%. That means that for every $100 of value you put in, you can borrow 50. It's usually safer to add more collateral than required to reduce liquidization. In the numbers that we're talking about, the returns are not going to be as great as you think, and things can move pretty fast. At the moment, this is mainly whales that are using this yield farming. Many systems will use a very high collateralization ratio, as much as 750%, to keep the entire platform safe. To be honest, that sounds like a safer thing. That's if you have that amount spare, that sort of money that you can afford to lose to put in to make meager returns. It's not a simple thing, yield farming. It's not simple. The most profitable strategies are highly complex and they're for advanced users. People that have been trading for years, people that have been into crypto for years, that are whales, that have got large collateral and they know that they can afford to lose what they're risking. They've got lots of risk capital. So I warn new people from getting into yield farming. It's not as easy as it seems, and if you don't understand what you're doing, you'll likely lose a lot of money. Your collateral can just be liquidated like a flick of a finger. Another risk is due to smart contracts. Many are built by small, smarter startup teams. So there's a risk of them being hacked. There's a risk of the funds going missing. There's the same risks as was in the ICO arena. You need to take this into account when you're locking your collateral into a smart contract. And many of them are small startups. They're not, just because they're built on Ethereum, they're nothing like as safe as Ethereum. One of the biggest advantages is also one of the greatest risks. It's the idea of composability. DeFi protocols are permissionless and can integrate with one another. This means that the entire DeFi ecosystem is heavily reliant on each of its building blocks. That's what we refer to when we say that these applications are composable. They can easily work together. They can have synergy together. They can form together and do things together. That is a big thing about crypto, and especially DeFi. It's this togetherness. Why is it a risk then? Well, it's one of the building blocks doesn't work as intended. The whole ecosystem may suffer. So this is what poses the greatest risk to yield farmers and liquidity pools. You not only have to trust the protocol you deposit your funds to, but all the others that it's reliant upon. So how can we earn these yield farming rewards? Well, there isn't a set way to do yield farming. In fact, yield farming strategies may change by the hour. That's another thing, you've got to keep updated. It's a time consuming thing. You need to have time, you need to have money. Each platform and strategy will have its own rules and risks. So if you want to get started with yield farming, you must get familiar with how decentralized liquidity pools work. Right, the basic idea now. You deposit funds into a smart contract and earn rewards in return, but the implementations, they can vary greatly. As such, it's not a great idea to blindly deposit your hard-earned funds and hope for high returns. As a basic rule of risk management, you need to be able to remain in control of your investment at all times, and with yield farming, that's not easy. So what are the popular platforms? I've said Compound Finance. Compound is an algorithmic money market that allows you to lend and borrow assets. Anyone with an Ethereum wallet can supply assets to Compound, the liquidity pool, and earn rewards immediately. Begin compounding. The rates are adjusted algorithmically based on supply and demand. Compound is the core protocol of the yield farming ecosystem. MakerDAO, that's been around for a while. It's a decentralized, of course, credit platform that supports the creation of DAI, the stablecoin DAI, which is built on Ethereum, which is very good actually. I've studied DAI at BlockGeeks. And it's a stablecoin algorithmically pegged to the value of US dollar. Anyone can open and make a vault where they lock collateral assets in, such as ETH, BAT, BAT, Basic Attention Token, USDC. They can generate DAI as debt against this collateral they've locked, and this debt incurs interest over time called the stability fee, the rate of which is set by Maker token holders, MakerDAO token holders. Yield farmers may use Maker to mint DAI to use in yield farming strategies. Synthetics, I own Synthetics. It's a DeFi. It has been a good performing one. When it runs, it really runs up high. And what it is it's a synthetic asset protocol. It allows anyone to lock up and stake synthetic tokens, which is what I own, or Ethereum, as a collateral, and mint synthetic assets against it. What can be a synthetic asset? Practically anything that has a reliable price feed. This allows virtually any financial asset to be added to Synthetics platform, so all your cryptos. And Synthetics may also allow all sorts of assets to be used for yield farming in the future. So if you want to use your long-term gold bags and yield farming strategies, synthetic assets were maybe the way to go. Aave is another one that I invested in and made. On the 14th of, I bought it for 5 cents and it went up to 70. Some people bought it for 1 cent in March and it went up to 96. So it times by 96. So if you put $1,000 into it, you're withdrawing 96,000 US dollars or pounds or whatever you did, euros. If you put 10 grand in, you're talking about nearly $1 million, in 4 months, from March to August, 5 months. It was the best performing one this year, AVE Lend protocol. And it's a decentralized protocol for lending and borrowing. Interest rates are adjusted algorithmically based on current market conditions. Lenders get A tokens in return for their funds. These tokens immediately start earning and compounding interest upon depositing. AVE also allows other advanced functionality such as flash loans. As a decentralized lending and borrowing protocol, AVE is heavily used by yield farmers. That's why you get a lot of price action up and down on Lend. It's very volatile. Uni Swap, this is that new one that I keep hearing about. Uni Swap. It's a decentralized exchange, a DEX, a DEX, and it's a protocol that allows for trustless token swaps. So liquidity providers deposit an equivalent value of 2 tokens to create a market. Traders can then trade against that liquidity pool. In return for supplying liquidity, liquidity providers earn fees from trades that happen in their pool. So Uniswap has been one of the most popular platforms for trustless token swaps due to its frictionless nature. This can come in handy for yield farming strategies. Curve Finance. I've heard a lot about Curve Finance. I haven't bought the token yet. But it's a decentralized exchange, much like Uniswap, specifically designed for efficient stablecoin swaps. Unlike other similar protocols like Uniswap, Curve allows users to make high-value stablecoin swaps with low slippage. That's interesting. As you'd imagine, due to the abundance of stablecoins in the yield farming scene, Curve pools are a key part of the infrastructure. Balancer. There's Balancer, which is a liquidity protocol similar to Uniswap and Curve. However, the key difference is that it allows for custom token allocations in a liquidity pool. That means that it allows liquidity pool providers to create custom balancer pools instead of the 50-50 allocations used by Uniswap. You can customize it, so you can have different allocations, like 50, you could have, instead of 50-50, 70-30 or 80-20, depending on your risk reward ratio and what you are desiring to risk. So just like with Uniswap, LPs are liquidity providers, and they earn fees for the trades that happen in their liquidity pool. Due to the flexibility with Balancer, it brings to liquidity pool creation. Balancer is important innovation in the space. Yearn Finance is one that's been spoken about all the time recently because of the price rises that it's had, and that it was priced the same as Bitcoin just recently, and it's gone to 40,000, 50,000, and we all were expecting Bitcoin to maybe do that, according to stock to flow ratio, SF2, stock to flow ratio 2, SF2, you know, the Plan B guy on Twitter, the one that has said that after the halving, 55 is a fair price up until December 2021, when he expects it to be 100. We'll wait and see. A lot of people have completely poo-pooed it, but Bitcoin has a habit of running into FOMO hype cycles, which could take it beyond 100k by 2021. I don't think it will, but you never know. You know, when the emotion gets involved and the FOMO, it could easily go beyond 100k. Whether it's a reliable, the stock to flow ratio, whether it's a reliable source to trade upon, I'm not so sure, but over a long term, it's yet to be proven that it's rubbish yet, for me personally. I think Bitcoin could go to 26,000 by December 2021. I think that would be a great boost to the overall market without a hype cycle. You know, it's gonna get more liquidity, and it's not going to have such big market cycles as before. Whether that's this market cycle, I'm not sure yet. We'll have to wait and see. So Yearn Finance is a decentralized ecosystem of aggregators for lending services, such as AVE that I spoke about earlier, and Compound and others. and it aims to optimize token lending by algorithmically finding the most profitable lending services. So it's like a search engine similar to that. Funds are converted to Y tokens, Yearn finance tokens, upon depositing, that periodically rebalance to maximize profit. Yearn finance is useful for farmers who want a protocol that automatically chooses the best strategies for them. So it's, as I say, it's like a search engine, and it is like a price comparison site that finds you the best. So let me just close on this whole yield farming space and what I think of it. I think that it's, as I've not looked into it myself in great detail, I'm learning about it and I'm sharing with you as I'm learning. And my first impressions, always really important to share with people, because it's how you see it first. You know, after a while, my opinion might change. The way I see it, it's a craze. It's a bubble, if you like. People thought that DeFi was a bubble. I never thought DeFi was a bubble. I thought DeFi is the term that's going to be used to take over the term cryptocurrency. DeFi is going to be decentralized finance. So it's decentralized banking, which is going to gradually take over mainstream banking the way we see it. And I've always thought that. When people are saying DeFi is a bubble, it's, you know, some of the coins were in a bubble, the prices of the coins, but the overall concept and the context of that concept is the one that's going to take over the space, really. The one that, you know, it's giving the whole space a use case. It's decentralized finance, so it's decentralized banking. Right, just to finish on this, so it's impossible to see what might spring up in the next few months. Nevertheless, the concept of trustless liquidity protocols is an interesting concept, and other DeFi products are certainly looking to be at the cutting edge of the finance. So, you know, this is not going to go away. Crypto economics and computer science and yield farming is here now, and it's not going to go away. It might be phased out, but before that, I think there's going to be a lot more said and done about yield farming. But as I say, it's mainly for whales at the moment and people with a lot of collateral and a lot of risk capital. So if you're just dabbling into the space and you're buying a bit of Bitcoin, and these are the people that I'm having conversations with on my Zoom, my one-to-one crypto for beginners, giving them just the idea, the basic concept of blockchain technology, cryptocurrency and decentralized finance, I don't think that it's for you, unless you're going to do your own research and really find out about the complexities of the sector. I would advise to leave it alone. Don't start jumping in, putting skin in the game in there already. I wouldn't do that. Okay folks, I'll be back later with a technical analysis video. That's all I've got to say about yield farming for now.